Stocks drift lower as concerns over US trade resurface. Realty and consumer durables are the big losers, while autos and FMCG eke out gains.
Mahindra & Mahindra stock gains after a better than expected quarter. It has several analysts revising their price targets. Most expect the auto major to continue growing strongly in tractors, SUVs and electric vehicles.
Banks led by SBI and PNB are likely to file a review petition on Supreme Court's order scrapping JSW Steel's acquisition of Bhushan Power and Steel. IOB tells CNBC-TV18 all options are on the table and a final decision is likely in a few days.
Pharma stocks slip after the US President Donald Trump signs an executive order to boost domestic production by asking the FDA to speed up approvals for local units and increase fees and inspections for foreign producers.
Aether Energy makes a subdued entry on the bourse's listing with a small premium to the offer price of around 325 rupees per share. The EV maker remains confident of growing volumes, market share and margins in FY26.
You're watching us here on Halftime Report. Good afternoon. I'm Mangalam Malu. With me is Ekta Batra. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's a day of consolidation that we're seeing on the frontline indices. We have the Nifty down by almost 90 odd points. After a rally, this was on the card, especially given the uncertainties around the border.
Yes, absolutely, Mangalam. Well, it's definitely, a session where the markets are a little unsure at this point in time. So we have the mid-cap index also, which is under pressure, so down around 1.3% currently for the mid-cap index. The Bank Nifty also under pressure, down around 0.8%. If you see it, the advanced decline ratio as well, let's see whether there's any kind of improvement as the day goes on, but currently stands at around 1:2 on the Bombay Stock Exchange. Lot of stocks within the broader markets which are moving. So, for example, Adani Enterprises is down around 3 odd percent. IndusInd Bank is under pressure, along with the likes of BPCL and Cipla. So, a lot going on. I think it is geopolitics as well as the uncertainty in terms of what the Trump actions could be in the next couple of days, which is really weighing on the markets and sentiment. But let's shift focus to earnings season now. Godrej Consumer is expected to report its Q4 numbers. Mangalam, back to you then. What are we expecting?
So Godrej Consumer, we have a cheat sheet. After the debacle that we saw in the company in the third quarter, thereafter the company's focus was on reviving volumes, and that's reflected in the share price as well. Currently, it's mildly lower in line with the market, but if you look at the last 7 days or so, or the last 1 month itself, the stock is up around 10%. This year, the stock is up around 18 odd percent. So, a large part of the recovery is something that is priced in, trading at around 47 times FY27 price to earnings as well. What the management has said in its business update is that the focus remained on reviving volume growth, and that's come by 4 to 5% volume growth is what the street is working with this time around, because that's what the company said in terms of mid-single digit volume growth. And the India growth is likely to be in high single digits. Add all of that together, the street expects a near 7% growth on the consolidated top line. The number you're looking at comes up for you on the screen. 7.2% growth versus same time last quarter is what the street is expecting on the top line. However, the EBITDA is likely to decline. And the reason why you see that is because, of the high increase in palm oil prices, palm fatty oil prices, and that would reflect in EBITDA margins decline by about 200 basis points as well. So from 22% goes down the way to 20.01% itself. Importantly, the net profit, the number you're looking at should be 483 crores. And look at it at an absolute level and not comparison, because the same time last year, there was an exceptional loss of nearly 2,400 crore rupees. More importantly, just keep an eye out on the volumes. 4 to 5% is what the street is working with, and that will be led by high teens growth coming in the home care business and a decline coming in the personal care business on account of volumes dipping in the soaps because of the price hikes that the company had taken. Indonesia is likely to recover, so is Africa. The most important thing to watch out for will be the strategic outlook that the management makes for FY26 and beyond. They've invited the press tomorrow for a conference. Let's see what the company has in store. But the other stock on our radar is M&M, doing extremely well after the numbers came by yesterday. It's up nearly 6.5% from the lows of yesterday. Brokerage is positive on the stock as well. Sudarshan joins in to tell us what exactly the brokerages are saying. Sudarshan.
So it's a consensus buy. Do you know the interesting part in all the auto stocks? It's the only stock which does not have any negative brokerage call. All the brokerages are positive on the stock. And this after a strong set of earnings that company has reported for Q4 FY25. And now brokerages are also bullish on its outlook. It has given a very positive outlook for both of its segments, auto as well as tractor segment. So now we'll start with Kotak Institutional Equities. It maintains its buy call and target here is 3,500 per share. It believes that company will continue outperforming industry growth even in FY26 after a strong set of earnings that reported for FY25. And Jefferies too has a buy call and has a target of 4,000 per share. It says company has delivered 12th consecutive quarter of double-digit EBITDA growth, and it expects 12% volume and 18% core EPS CAGR over FY25-28. And after a strong set of earnings and growth that company has seen over the last 2 to 3 years, it believes that there is a further room for re-rating with strong growth outlook and improving franchise. Jefferies has a, sorry, my bad. So all these brokerages, even CLSA has a buy call on the stock, another Nomura too has a buy call on the stock, and it's on the back of all the strong set of earnings and the positive outlook. And that's the reason you are seeing the not big move. It has come off highs, but still up 2% in today's trade.
Okay, all right, Sudarshan, thanks very much for that. So that's M&M, that stock up around 2%. Well, we need to take a short break, but before we do that, here's a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now and submit your entry for SME Champion Awards Season 2.
Welcome back. You're watching us here on Halftime Report on CNBC-TV18. In an otherwise wobbly market, one of the stocks which is surging ahead is CCL Products. It's a solid set of numbers that the company has reported. A 15% growth in their revenue, a much higher jump in their profitability and EBITDA as well. So let's get chatting with the management. Chala Srisant joins in for a quick update on these numbers, but more importantly, the outlook for the year going ahead as well. Chala, first up, before we get chatting about the volume growth target and EBITDA per kg numbers, coffee prices, they've surged world over. Now, they don't impact your margins immediately because you have a cost-plus model. The coffee prices don't look like they're coming down in a hurry. In that, what could the impact be on client behavior, your incremental capacity utilization and domestic branded business? What are your thoughts?
So what we have seen is that most of the customers, they've started migrating from a long-term contract. Usually we have customers who are doing 2 years, 3 years contracts as well when the prices were stable. They've started bringing that down to 6 months to 1 year. So that is one significant impact. And as far as the coffee prices are concerned, yes, things have been volatile. But Brazil has actually been investing a lot in increasing the coffee throughput. So, in fact, this is one of the first years. The crop is going to be coming in the next week or two. So we'll know how the flow is going to be in the next 3-4 days, actually. And that will give us clarity about how the prices are going to move going forward. So we're expecting that there could be a correction if the crop is good.
So what does this do to your incremental capacity utilization? Because you've laid out a fair amount of capacity, and if the contract cycles are shortening, then is there a case that, you might have capacity which you may not be able to fill?
So that is the beauty of our business. If you look at it historically, irrespective of the coffee prices, we've been able to fill our volumes. So we keep adding new customers every year, and that's what we've been doing over the past years, and we're still continuing to do that now also. So irrespective of whether the prices go up or down, we're confident that our volume guidance will still continue, and we will continue to keep growing forward as well.
So if you could just expand a little bit in terms of the volume guidance, if you could just break up what you did this quarter, what you closed the year with, and what you are targeting for FY26 based on the pricing scenario.
So this whole year, we had given a guidance of around a 10% volume growth, and we are more or less around that range. But going forward, we are actually looking at maybe a 10 to 20% volume growth for the current financial year.
So you're expecting as much as a 10 to 20% volume growth in FY26?
Yes.
Okay, so that range is quite wide. If you could just tell us what's it predicated on?
So one of the main reasons is because we are getting orders again on a back-to-back basis with shorter lead times. It's a little difficult for us to predict the way we used to predict earlier. If you recall, in the last couple of years, we actually used to give a guidance which was very accurate with a much narrower number. That was because of the long-term contracts that we used to get in place before the start of the financial year. So now, since we don't have that in place, we're keeping this range, a wider range at this point in time.
All right. What about, a couple of things. One, in the very near term, what is the EBITDA per kg target that you have for FY26? What was it in FY25? Because I remember the third quarter was 114 rupees. And over the next 5 to 10 years, as you increase your capacity, as you increase your footprint, what is your market share aspiration? Your global market share is still 7 to 8% itself, and India as well is 3 to 4% on the B2C side. What's your aspiration here? So very near-term EBITDA per kg and long-term market share.
So EBITDA per kg has moved up from that 114 to around 120, 125 range. And again, this is because of the product mix changes, new products that we are launching. So all these things have contributed positively. And we're also adding a lot of end customers that is helping us with this growth. We are hoping that we can continue with the similar EBITDA per kg going forward as well. And as far as the market share is concerned, yes, we are at about 7%, but with the volumes that we are growing year on year, we are hoping that within the next couple of years, we should be crossing that 10% mark as well.
Okay. If you could just highlight what might be the biggest variable that you see going into FY26 or the biggest headwind that you're probably bracing for, what would it be?
To be frank, our company has withstood almost everything, let it be from COVID to war situations, recession, you name it, tariffs, unpredictable tariffs, terrorist attacks, whatever it is. So whatever the circumstances are, we've always seen that because of our presence in India and Vietnam, we have an added advantage of being flexible. So even if there's an issue in one country, we have the ability to transition production to another country. So we're quite confident that whatever comes, we will be able to face it head on.
Everyone, no matter what happens, everyone needs their cup of coffee regularly, globally, I guess. So that keeps you resilient. Chala, you spoke about the global business. Let's talk about India, because your domestic business, you did have a target of 300 crores in FY25. Wonder whether you crossed that or not. And you still have 65 to 70% sales coming in from South India. You reach about 120,000 stores. What's your prognosis here? At what pace are you likely to expand here? What is the target here in terms of reach, in terms of revenue, non-South portfolio? What's the aspiration?
So yes, we did cross our 300 crores. In fact, the interesting part is for this year, it's our 30th year. We crossed 3,000 crores as a top line for the whole company. We crossed 300 crores in the bottom line, and we crossed 300 crores for the branded business as well. So number 3 seems to have a lot of significance for us in this year. And the domestic sale was actually around 450 crores. The brand was crossing 300 crores. And going forward also, we are expecting about a 40% top line growth in the domestic market for this year.
Wow, that's fantastic. 40% domestic growth. Just what did you do in the year gone by? What did you close at?
We had done about 450 crores.
Okay, all right. So just wanted to also narrow down on the balance sheet. You have debt of around 2,000 odd crores, if I'm not mistaken, as of the last quarter. So give us a sense in terms of where your gross debt stands.
Yeah.
How much of it is working capital? What is the plan to reduce it in FY26, considering that you're quite bullish in terms of your P&L?
So actually, we had projected that we should end between 2,000 to 2,200 crores, but we actually ended much lower. Around 1,800 crores is what we actually ended the year with. We had focused, we had done a little bit of renegotiation with some of our customers also for earlier payments. So all these things helped reduce the debt for us. And going forward, yes, there is a volume growth. So we are expecting a slight increase in the working capital. The term loans, we have about 700 to 800 crores of term loan, which is there, which we are going to repay within the next 3 years, and then we'll be debt free. It's only going to be the working capital that is that part of our regular business.
All right, and final question. What about the FMCG subsidiary that you have? What's the update here? You were dabbling in various categories. Is it still at planning stage? How much of that has been executed? What are the near-term targets here?
So the FMCG business has actually been merged with the parent company, and that's the update which I had mentioned about the 300 crores of branded business and 450 crores of overall sales within India. The subsidiary company right now, there's a kiosk vertical that is there, which we are still in the initial stages over there.
So no other categories that you're seeding, because earlier the story was that the FMCG vertical sits in a separate house. Thereafter, there could be perhaps some sort of volume, value unlocking there.
Yes,
so reaches a certain scale.
There will be some new product launch. Yeah, there will be some new product launches in the next couple of months itself. So all that is sitting actually in the parent company itself. The vertical that we hyped off, that has only the kiosk business at this point in time.
Take that point, Chala. Thank you so much for joining in and giving us all those updates. It's number 3, which is lucky for you. Hopefully, as the years go along, those numbers keep increasing for you as well. 14% higher on the stock. And we have, the management giving a strong outlook for the next year. 10 to 20% volume growth, a wide range because of the variables. But the EBITDA crosses 120 per kg all of next year. Take a short break, come back. We also, after our daily dose of coffee, get our daily dose of pharma. Vishal Manchanda, who's the analyst at Systematics, joins in to discuss the pharma sector.
Welcome back. Well, pharma stocks continue to be in focus today. The US President Donald Trump has signed an executive order on Monday that aims to reduce the time it takes to approve pharmaceutical plants in the country as part of new regulations to encourage domestic manufacturing. Listen in.
That's what it's all about, right? Very important. We're going to have a big announcement next week on some of this kind of thing, but more related to costs, the costs of medicines and drugs, because we're being ripped off, as you know, very badly, being ripped off compared to the rest of the world.
Many actions that you've taken so far in this administration, sir, are related to onshoring manufacturing and onshoring supply chains. One of the most important supply chain issues we currently face as a country is our pharmaceutical supply chain. This is an executive order intended to promote domestic manufacturing of pharmaceuticals. It streamlines the permitting processes that go into building domestic pharmaceutical manufacturing sites. It centers a lot of the environmental permitting process, which is quite significant within the EPA, and it takes other actions designed to ensure that we're bringing pharmaceutical jobs and pharmaceutical manufacturing back to the United States of America.
Okay.
All right, and when asked about the tariff rates on the pharma sector and the timing, this is what the US President Donald Trump had to say.
President, on the pharmaceutical side, have you made any determination on kind of what those tariff rates may look like and the timing of those
I
tariffs?
have. I'll announce it over the next 2 weeks.
All right, so very important developments which have come in for the entire Indian pharmaceutical space. So now there is no immediate impact really, Mangalam, in terms of what could happen. It just, what the executive order did was that they are just looking to fast track approvals for US-based manufacturing plants. They're increasing inspections and fees for foreign facilities. They're mandating public disclosure of API sources, public disclosure of non-compliant overseas facilities as well. But overall, what they are doing is they are trying to, yes, shift the balance of the global pharma production. They're not doing it immediately with this executive order, but they are small pieces which will add up to a larger puzzle. Right. And it's not really a disincentive to overseas manufacturing as yet. The move is to basically accelerate US-based approvals. And you're seeing the wind blow towards the US in any case. The likes of J&J, Roche, Eli Lilly, Novartis, they've all announced investments in the US. The larger picture which we need to watch out for is the pharma tariffs, which could be announced in the next 2 weeks. The US government has concluded a Section 232 investigation, which basically is looking at the national security implications of importing drugs and APIs. So I think that would be the most important thing to watch out for. To talk more about this, we have Vishal Manchanda, who's joining in. He's the pharma analyst at Systematics, who's with us now. Vishal, hi. Thanks very much for taking the time out. What is your reading of this executive order?
So I think the regulatory incentives that have been announced, they broadly don't really change things too much from a economics perspective for the manufacturers. So these are, I think, that's the starting point, and they'll have to kind of do more to get manufacturing in the US. So I think this is just the starting point. And it's a massive task that US has taken up. And probably I don't think whether they can actually get too much of manufacturing despite of whatever they do to get manufacturing in the US. Because we know that the cost of manufacturing in the US is significantly higher, say 2x, 3x of what it is in the, say, India and China.
Okay, so that's exactly what my point was. How realistic is it to manufacture generic drugs in the US vis-a-vis India?
So I think one is the supply chain. So like every generic drug, every formulation has a unique supply chain. So even if you do the final formulation in the US, you would still be dependent on a country like India or China for your raw materials. And if you want to kind of replicate the entire value chain for one formulation, even that's a massive task. And if you look at the US market, I'm sure there would be more than 5,000 different formulations in the US. So every formulation has a unique supply chain. And so it very well shows how difficult it is to kind of get manufacturing done in the US. Because ultimately, the supply chain will have linkages to India and US. And that's where probably India. So that's where India and China can still control a lot of things.
Okay, all right. That point is taken. But Vishal, just wanted to get a sense that which are the most resilient companies according to you at this point in time? From an Indian standpoint, which have some presence in the US, which companies would those be, which can probably ramp up their manufacturing in the US and hence probably have, their foot in the door?
I think I don't think companies will resort to ramping up manufacturing in the US because even if they do that, they probably will still not be able to close the gap in terms of so markets. So like even if you put tariffs, say even if you put 25% tariffs, 30% tariffs, the tariffs have to be massive in order to ensure companies move their manufacturing to the US. And then we know the timelines of pushing manufacturing to the US. It takes 4 or 5 years. With all the acceleration they are trying to do in the regulatory process, if they might cut it short by say 6 months. So ultimately, I think execution is something I'm not able to figure out whether this can actually be executed. So that's the key issue, I think. And I don't think companies will go about moving manufacturing to the US. They might probably increase whatever. So like Cipla has plants in the US. They'll try to utilize those plants better. I think that's what we can see.
The other part of that is the US FDA actually increasing their scrutiny on countries outside of the US. Do you see that as an incremental event risk for our players, or do you think this volatility will continue and we'll probably get the better out of it?
Yes, I think that's something we'll have to wait and see. They're also going to raise the facility fees and probably use that as a funding to do more inspections in India, China, and other countries. So I think that's something we'll have to wait and see how that pans out. But ultimately, I think with all of these things, if the supply demand gets imbalanced, there will be an inflation problem in the US.
Okay, there will be an inflation problem in the US. The other part was about the sourcing of the APIs. That has to be publicly listed, as well as the plants which are non-compliant have to be publicly listed. How would you read that?
I think listing the API source has become very important for the US, because they want to figure out what percentage of where is the supply coming from actually. They need to trace their supply chain. Only then probably they can actually formulate a strategy when they know how dependent are they on these markets in terms of the supply values. And API is a crucial component. So probably the formulation may be coming from India, but the API is still coming from China. And probably everything that is coming from India has a linkage to a Chinese supplier. So ultimately, you have to diversify your value chain. I think that's most important for the US. They have to ensure there are separate supply chains, not linked to the US, not linked to China or India. I think that's where they would be focusing on.
All right, take that point. And basis all that's happening right now, what stock, according to you, offers the best upside?
So I think in the large cap space, we kind of continue to like Sun and Cipla because of lower US dependence, 30% of sales coming from the US. We'll continue to avoid names with 40 to 50% sales coming from US and more of dependence on one product, two product for their profit. So I think Sun and Cipla would figure better among the names there.
Okay, all right. Thanks very much, Vishal, for joining in and speaking with us and giving us your perspective. So maybe not an immediate shift is what we can expect. Maybe a lot of companies will improve or utilize their plants better in the US. That's the view coming in. Well, staying with the pharma space, we now have with us Neeraj Sharma, who's the Managing Director and CEO at OneSource Specialty Pharma, joining in to talk about their Q4 numbers. Mr. Sharma, welcome to the show. If you could just start by giving us your performance on the margins, which was spectacular this quarter, over 40-odd%. What led to that improvement from, say, that 36% in the previous quarter? And what is the trajectory that we expect in FY26?
Yeah, thank you for having me on the show. So we have had a very robust quarter, but not just the quarter. We have had a very robust year, and a number of factors which have actually helped us increase our both revenue as well as profitability numbers. We have, as we have said, we have added a number of new customers, and added to these customer acquisition also are significant MSA executions we have done. A significant part of our business is coming from drug device combinations, and here we have had a lot of new MSAs which we executed, especially our customers who are planning for second wave launch, especially of semaglutide in the next year. So combined with our other legs of the business, especially our soft gelatin capsules, our sterile injectables. So all put together, along with the new acquisition which we did of customers, what has really helped us drive both our revenue and our margin. And we see this trend continuing in terms of our the guidance which we have given. We have reaffirmed our midterm guidance, as we have said. We are going to be a 400 million revenue company by 2028, and also with a very strong 40% EBITDA range. So we have reaffirmed that, and that also all these factors which I mentioned our continued expansion of our drug device combination business, a lot of it getting commercialized, actually starting from the current year or the latter part of current year itself, and then going steady state in FY27 and beyond, especially on semaglutide coming off patent in some of the large markets. Our soft gelatin business, where, as you're aware, we have expanded our capacities 3x over the last year, and a lot of new CDMO business coming on this, and finally the sterile injectable. So all in all, coming together to deliver our midterm outlook, which we have given for the business.
Okay, all right. Well, your midterm guidance seems to be quite strong, but I'm just going to narrow down on the opportunity from the entire weight loss scenario, weight loss drug scenario, with semaglutide going off patent in a couple of countries in the next year odd. What is the opportunity in terms of financials which is lined up for you? Which are the companies that you have probably tied up with in terms of the semaglutide opportunity?
It's actually 100 plus countries actually which are going off patent next year. But the key ones which are very significant today are Canada, Brazil, China, India, and some of the countries in the Middle East, we have significant populations today and significant markets. And these are the ones which are going to be really driving the near-term numbers for us. And while obviously as a CDMO I can't share the names of customers, but I can tell you we have a very, very large and diverse customer base. We have said 20 plus customers who are with us for GLP, and these customers are really the who's who of the global generic industry, including global leaders, regional leaders, country leaders. And we see that with these customers of ours, we will be able to support them.
Sure, Mr. Sharma, just a two-part question. One, how many suppliers or how many CDMO suppliers would be there typically for one generic company which is manufacturing semaglutide? And two, do you see maybe the market shrinking for semaglutide simply because there is going to be a lot of generic competition come through and there are far superior molecules now which are under patent, which are in the space?
First question, to get a product like semaglutide to develop and to get into the market, a company spends anywhere between 25 to 30 million US dollars. So, with this significant investment, and it's a complex product, it's not a product where there are multiple suppliers for a company. So we expect, all our customers, us to be either the sole suppliers, or in some cases where, some companies might want to take some capacity in-house, we would still remain the principal supplier. So I think that's where it's not an area where you can have multiple suppliers for a company or for a product like this. That's the first part. And when it comes, where you expect semaglutide, what's happening in the market, I think right now there is such a huge demand-supply gap for this product. There is a significant market out there, whether it is for diabetes, whether it is for weight loss, the anti-obesity. And the supply from the innovator has been absolutely minuscule. So just to give you some figures here, in a large market like Brazil, less than 1% of the potential target population is having access to these drugs today. In a market like Canada, the same number is about 3 to 4%. So as you can see, there is a significant unmet demand, which is what is going to really be driven when the generics come into the market, post-market formation and patent expiry. So we see that to be driving over the next 4 to 5 years,
right.
Not only companies like OneSource, but all the generics who will get into the market. To your point on other new therapies, for sure, this is an area which is revolutionized. Remember, there are 1.5 to 2 billion people potentially who could benefit from these drugs. So every new therapy or every new drug which comes into the market is welcome, including some of the oral therapies which will be coming. So it's, I think, this is a revolutionary therapy, and it will be very helpful to people. And OneSource is really poised with our experience, with our expertise, with
Mr.
our
Sharma, we get that.
We are very well placed.
Right, we take that, Mr. Sharma. Just a final question before we let you go. You've announced a capex of about $100 million as well. What does that entail in terms of, turnover ratio? How much do we typically garner of the capex that you do? That's point number one. And secondly, you did 32% margins in FY25 with a long-term guidance of 40%. By when do you reach 40%? I mean, if you have a glide path to that. So on margins and capex, the asset turnover, quickly.
Yeah. So we have already said that we'll be spending almost $100 million over the next 2.5 years. This primarily investing in expanding our drug-device combination, drug-device combination capacity, which is what we really need to service our customers' demands. And this is a very, very attractive business. We are right now, we have closed FY25 just under asset turn of just under 2. And we see that, in near term to be at least 2.5 and a steady state asset turn of 3. That's what we are aiming for. And in terms of margins, we have said, you've seen how our margins have expanded, and we expect the 40% steady state margins not far. We have already said that our first full year of commercialization of semaglutide will be FY27. So for sure, FY27 and beyond is a 40% plus steady state margin, what we are aiming for.
Okay, just before we let you go, maybe a one-word answer from you. Out of, say, the number of companies, looking at semaglutide, if you could name the number there as well, how many do you have in terms of, say, a percentage or an absolute form in terms of being the sole supplier or principal CDMO supplier?
So there's no one word. As I said, we have our customers, we have global customers, and through those customers, we expect them to have a very significant share of all the markets which are opening up in 2026.
All right. Take that point. Thanks a lot, Mr. Sharma, for joining in. Wish you good luck. We'll speak to you at the end of the next quarter as well. Once again, quiz you on all the things that we spoke about today as well. Take a short break. Come back, focus on the markets as well. The Nifty down about 75 points. Sachidanand Tekar joins in with some trading strategies on the other side.
Welcome back. Well, for the markets, it is under pressure, but let's talk about specific stocks right now. Exide Industries is in focus. The management says that they are in advanced discussions for battery manufacturing with two major two-wheeler companies and a three-wheeler company. Sudarshan joins in with these details. Sudarshan.
So we are seeing some recovery in this stock of Exide Industry. It's on the back of the commentary that company has given that it currently con call is going on for Q4 FY25 results. Results were slightly below estimates, but now in the commentary, company has talked about certain orders that it's likely to receive. First, it's saying that it's in advanced talks with two major two-wheeler companies related to battery manufacturing. Also, regarding the three-wheeler, it's saying that it's in talks with few players, and there also it can receive orders for battery manufacturing. One update that everyone has been waiting related to what has happened, what's the update on Hyundai agreement, that binding agreement that company had signed few months ago. Company had announced that earlier it had signed non-binding, which had turned binding. So what's the update to that? And on that, company has commented that it's as per whatever the company has announced, it's there in public domain. But the update is that battery manufacturing will happen very soon, and it's in the stage of product development, and that is company is making it ready, and it's going to be ready very soon. And once it's ready, it will start manufacturing for Hyundai agreement. So there is nothing negative as far as Hyundai agreement is concerned. The plan has been on the track. So on the basis of these comments, we are seeing a recovery in the stock of Exide Industries.
Take that point, Sudarshan. Thanks a lot for that. That's about Exide Industries, currently marginally in the red, but has recovered from the lows of today's trading session so far as well. Speaking about today's trading session, let's get an update on how the F&O setup is. 2 days ahead of expiry, we're seeing some consolidation. The Nifty has been consolidating in this 24,400 to 24,500 sort of range. And right now, it's the Nifty Bank, which is lower for the last few trading sessions, below the 55,000 mark as well. Currently around 54,500 for that index. The mid-cap index also is under a wee bit of pressure. It's the groups which are in focus. Yesterday we had the Adani Group stocks doing extremely well. Today they're coming in for some profit taking. So Adani and Adani Ports from the broader markets. You have Adani Total and Adani Green as well. And then stocks in focus on account of numbers and guidances. So Indian Hotels seeing some profit booking down 5% after what was a very good quarter and good management commentary as well. But Cummins as well lower because the parent has withdrawn their guidance. Ahead of results, there is some sell-off that we're seeing in Paytm down about 4.5%. For the index, however, consolidation is expected. We're around 24,400 right now, and that's where the calls and puts are most active as well. 24,400 call has a premium of 60 rupees. So look at the 24,400 put, that has a premium of roughly 70 rupees. Add both of them together, you're looking for a Nifty range between 24,250 to 24,550. That's the consolidation that the street is expecting. Just keeping an eye out on CDSL. There has been a big spike in the open interest, still below the 95% threshold mark. But if it does continue to spike towards the remainder of today's trading session, we may see the stock enter the F&O band. That's about CDSL. And as we speak, at the bottom of your screen, numbers from Polycab. The stock did well after RR Cabal's numbers. Let's see how much of that is in the price already. On the bottom line, it looks like a beat on the profitability, 726 crores versus a CNBC-TV18 poll of 637 crores. We'll try and get the revenue and the EBITDA numbers up for you shortly. Okay, let's go to Sachidanand Uttekar then. Sachi, what do you make of the market so far? There is consolidation, and what does one do when it comes to individual stocks?
Good afternoon, Mangalam. Good afternoon, Ekta. I think the Nifty has been, lacking that strength to cross that hurdle of 24,450. For the last 3 trading sessions, we have seen narrow range bodies, but on the contrary, it has also not, breached below its 5-day exponential moving average support, which is placed somewhere close to around 24,350 thereabouts. So I think the overall range, is looking consolidative, as you rightly pointed out. The immediate range which is exhibited is somewhere close to around 24,450 on the higher side, and 24,250 looks like a decent, consolidation support. So it's better to, take positions on the long side when the Nifty displays a clear breakout about the 24,450 mark, or else on a decline near to that 24,250 consolidation support itself. So as of now, I think it's better to be very stock specific. One can look for buying opportunities within this ongoing bullish trend. The first stock on our radar is United Spirits. Now, if you look at the last 8 trading sessions, the stock was displaying a consolidation. It has displayed a firm breakout in today's trading session. The 1560 mark has been confidently breached on the higher side. If you look at the last couple of trading sessions, there has been a long addition in positions. And if you look at the overall pattern structure, it looks like a bullish flag formation, which is again a continuation pattern. And that's why we are recommending building long positions here, keeping a stop loss somewhere close to around 1555 on a closing basis. Fresh long positions can be added for a pattern target of around 1650. Disclosure would be that we have recommended this particular stock to our clients as well. The other pocket of strength is metals. Now, metals are showing signs of short covering. The stock which we like right now is JSW Steel. In the last 2 trading sessions, it has maintained its closing above its 200-day exponential moving average support, which is placed at around 960. And we have signs of short covering here. So we are expecting a good pullback towards 1,000 levels. And that's why we are recommending building long positions here, keeping a stop loss at around 960 on a closing basis.
All right, take that point, Sachi. We have some incremental details coming in for Polycab as well. It's a comprehensive beat on the top line. The EBITDA also above street expectations, and now the stock is up around 1%. Take a short break, come back more on the markets and stock-specific action.
Welcome back. Well, the Taiwan dollar posted its sharpest surge since 1988 amid trade deal speculations with the US. Prashant is here to explain more about this. Prashant.
Well, as they say, when fixed income and currency markets move, you better pay attention. And this is a story which is being talked about in exactly those markets, currency and fixed income, in a big way, but actually has got little or no attention in equity markets, not just here, but around the world. What has happened in Taiwan over the last 2 days is not normal. Actually, it's far from normal. The Taiwan dollar has surged 10% plus in just 2 trading sessions, a currency, right? This isn't just a currency move. Is it a signal? And that's the question that I'm asking here. Now, these are the moves that I'm talking about with regards to the currency, the Taiwanese dollar. It's pulled off a historic surge, up 5% last Friday, another 5% yesterday. So a 10% surge against the USD in 2 trading sessions. It's up a stunning 14% since the US dollar since the end of March. Mind you, we have not seen this kind of currency move, not even during the wild old days of the Asian financial crisis. So what is happening? Well, it is a classic case of a very long US dollar economy running into a weaker dollar. What do I mean by that line? The line that Taiwan is very long US dollars. Well, this table right here tells you the story. The private sector, along with the Taiwan Central Bank, together hold over $1 trillion US in reserves, foreign deposits and overseas investments as well. This is the breakup that I'm talking about. $1 trillion, over $1 trillion. So what's the problem really? Basically, as I said, the drivers for this sharp move are a mix of global macros meeting local factors. We all know that the US administration wants a weaker USD, US dollar. The dollar is sold off. The broader dollar, which is the dollar index, against a basket of currencies, is down 10% from 110 to about 100 in the last 4 months. So you have an economy, the Taiwanese economy, which is $1 trillion long on the US dollar at a time when the US dollar itself is facing a sharp slump in the value of the currency. So there is talk of exporters converting dollars. There is also a lot of chatter about how life insurance companies in Taiwan are responsible for some of this surge. So just to very quickly explain that life insurance point, because that's being discussed quite a bit, around 70% of the investments at Taiwan life insurers are invested overseas, mainly in dollar-denominated bonds and equities, of which only 30% match foreign currency-denominated life insurance policies. So there is a big mismatch here. Now, these life insurers in Taiwan do not 100% hedge the currency mismatch. So the chatter is that it could be that they are covering their positions in a very panicky and quick way. Added to this, there is also, of course, growing skepticism. And this is a broader point, but I think this is important. Broader skepticism around US economic exceptionalism itself starting to fade a little bit. The idea, what is exceptionalism? The idea that US assets should get a premium just because it is the US. The result, a dramatic forex reset. Now, Taiwan Central Bank yesterday clarified. They said 3 things. They said the US has not asked for this move. Basically, the fact that US has been accusing many countries that they've artificially kept their currencies depreciated, kept it very low. So the central bank in Taiwan said, no, this is not because of the US Treasury asking them to revalue the currency higher. They've asked corporates to stop panic selling the dollar. Most importantly and critically, they've also said that they won't fight the market. I mean, they essentially are not going to be in the market to stabilize the currency. The translation is that this is organic and it may or may not be over soon. There may be more left. Well, the currency sold off another 3% post the central bank clarification as the market took these statements by the central bank as not wanting to intervene. So here's the bigger question. Does Taiwan trigger a broader revaluation across Asia? Now, the economies which are big US dollar asset holders are Malaysia, Thailand, Philippines, Korea, also financial hubs like Singapore and Hong Kong. Could these be next? I think that's the other question. So yes, this is a Taiwan story, but it may be the first real test of a weaker dollar world in Asia. Is this a blip or the beginning of a bigger forex pivot? For India, here in India, the question for us is, will the damage be collateral at this stage? At least that's the question to my mind. The question is, if the rest of Asian currencies appreciate meaningfully from here, will it force that appreciation impact onto the Indian currency as well? Will we be able to hold on? It is an important question, well worth watching in the coming weeks and months. Back to you.
Okay, all right, Prashant, thanks very much for that. Well, we could benefit from a stronger rupee as well. Thanks very much. We will take a short break on that note. We'll get you more on the market stocks once we're back. Stay tuned. Welcome back. Well, under pressure for the markets at this point. Just want to point out that Poly Medicure, which comes out with its numbers, that stock is up around 6% We have a couple of other stocks such as Narayana Health, which is doing well, so up around 2.5% for that particular stock at this point in time as well. On the downside, just watch out for a couple of these big volume movers. So IRFC is down around 2%, huge volumes traded on that one. Mazagon Dock Shipyard, which was one of those defense plays, has done well this year, but nonetheless is down around 1.5% at this point. Bharat Dynamics giving it company, and even Edelweiss Financial Services, watch out for that stock. It's down around a sharp 4% at this point. So a couple of these stocks which are buzzing around. For the indices itself, down 76 points for the Nifty. The Sensex is down over 200 odd points. The Bank Nifty down over 400 odd points, and the mid-cap index underperforming today, taking the brunt of the losses, so down around 1.4% currently for the mid-cap index. But CG Power will also report its Q4 numbers today. Vimakshi is here with more.
A strong set of numbers is expected to come through from CG Power. When you look at the revenue, a growth of almost 25% is what our poll suggests. Revenue is expected to come in at 2,750 odd crores. The margins too are expected to improve by over 60 basis points to 13.5%, and the net profit too is expected to see a growth of almost 25%, coming in at almost 300 crores. Now, largely, let's look at what are the expectations with respect to the order inflow as well. Order inflow is expected to be healthy at 3,725 crores. The order book is also expected to show a very good, healthy growth and come in at 10,126 crores. Largely, when we look at the segment-wise performance, it is the power segment that is expected to outperform the industrial segment. Nomura, in fact, expects the power segment to post a growth of almost 32%, while the industrial segment is expected to post a growth of nearly 17%, similar to what we saw in the third quarter. As far as some key expectations, what do we watch out for? It will be the commentary on the demand outlook, especially for the short cycle products. Additionally, if you remember, the company had initiated an OSAT project a couple of months ago, and an update on the capex front out here would also be an important factor to watch out for. Largely, a good set of numbers are expected from CG Power.
Okay, all right, Vimakshi, thanks very much for that. So that's on CG Power. With that, it's also a wrap on Halftime Report. This is Lunch up next.